When people talk about growth ETFs, they almost always mention Invesco Nasdaq 100, Vanguard Growth, and Schwab Growth. But there's one ETF that's rarely mentioned, even though its long-term returns were outstanding. In fact, over the last decade and a half, this ETF has beaten almost every major growth ETF you've probably heard of. And it did so with one structural advantage that most ETFs simply don't have. The ETF is called Fidelity Nasdaq Composite Index ETF. Ticker is ONEQ. The Nasdaq Composite is one of the most important equity indices in the market, but the ETF linked to it is almost always overlooked. That ETF buys future market leaders early, before they're big enough for QQQ or the S&P 500. And unlike small cap indexes, it doesn't lose them as they grow. That combination is rare. Today, I'll show you what the ETF actually is, why its structure matters, how it performed over the long term, and what type of investors this ETF is suitable for. This isn't about hype, predictions, or bold claims. Everything you'll see is based on publicly available data and real-world results. It's about how index rules quietly shape returns over time. Before we continue, a quick disclaimer. This video is for educational purposes only and is not financial advice. Without further ado, let's begin. So what exactly is ONEQ? Fidelity Nasdaq Composite Index ETF tracks the Nasdaq Composite Index, which includes nearly every company listed on the Nasdaq exchange. That means it holds large caps, mid caps, and smaller growth companies all in one index, not just the biggest names. This is very different from QQQ, which tracks the Nasdaq 100 and holds only the largest non-financial companies on the Nasdaq. In practice, QQQ owns companies after they have already become dominant. ONEQ, on the other hand, owns the entire Nasdaq ecosystem. When a company goes public on the Nasdaq and begins to grow, ONEQ can hold it early without waiting for size, profitability, or index promotion. From a cost and scale perspective, ONEQ is very solid. Its expense ratio is 0.21%, compared to 0.20% for QQQ, so it is only marginally more expensive. ONEQ manages about $9.33 billion in assets, while QQQ manages around $410.65 billion, making QQQ much larger, but not changing the underlying structure of how these ETFs work. And importantly, ONEQ is managed by Fidelity Investments, one of the largest and most reliable asset managers in the world. That's why ONEQ is often misunderstood. Many investors assume it is simply a more diversified version of QQQ, but structurally it plays a very different role. QQQ is a filter that selects today's leaders, while ONEQ is a net that captures companies while they are still becoming leaders. This is where ONEQ's real structural advantage shows up. Because it tracks the entire Nasdaq composite, the ETF can own companies early in their public life, long before they are large enough to be included in Invesco QQQ or the S&P 500. Tesla is a clear example. Tesla went public in 2010 at roughly $1 per share on a split-adjusted basis. By the time it entered S&P 500 in late 2020, it was already trading above $200. From IPO to S&P 500 inclusion, Tesla rose by roughly 17,000%. Yes, 17,000%. After joining the index, returns were still positive, but far more modest. This isn't a criticism of index investing, it's simply how index confirmation works. Inclusion comes after scale, and success are already visible. What makes ONEQ different from small-cap ETFs is that it does not lose those winners as they grow. Small-cap indexes like Russell 2000 are forced to sell companies once they become too large and graduate out of the index. That creates a structural problem. Small-cap ETFs may identify future leaders early, but they are required to let them go right as those businesses begin to scale into mid-cap and large-cap leaders. ONEQ avoids that problem entirely. When a company grows from small-cap to mid-cap and eventually into a large-cap leader, it simply stays in the index. ONEQ captures the full journey, from early growth through maturity. That combination is rare. ONEQ can discover future leaders early, and unlike small-cap indexes, it can keep them as they become great. Now let's look at performance, using the same rules across all ETFs. This backtest runs from March 2009 through November 2025 with identical daily contributions and no timing or leverage. In this first snapshot, we're comparing ONEQ against the major growth ETFs and the S&P 500. That includes QQQ, VUG, SPYG, IWF, and SPY. The result is very clear. ONEQ ranked second overall in this group. It was beaten only by QQQ, and it outperformed every other growth ETF and the S&P 500. That's important because ONEQ achieved this without concentrating heavily in a small group of mega-cap stocks. It delivered elite long-term growth while maintaining similar drawdowns and volatility to other growth funds. Now let's look at the second snapshot, where ONEQ is compared directly to Russell 2000 ETF, the IWM, a pure small cap one. The difference here is dramatic. Over the same period, ONEQ delivered far higher long-term returns than IWM, with meaningfully better risk-adjusted performance. This highlights a key structural issue with small cap indexes. They may identify future winners early, but they are forced to sell them as soon as those companies grow too large. ONEQ does not have that problem. It can capture companies early and then continue holding them as they scale into mid-cap and large-cap leaders. That ability to both discover future leaders and keep them as they grow is a major reason why ONEQ's long-term performance sits well above small-cap benchmarks. So, who is ONEQ actually suitable for? The ETF is not designed for short-term trading or performance chasing. It works best for investors with a long-term horizon who are comfortable holding through market cycles. ONEQ is particularly suitable for investors who want growth diversification without giving up growth itself. It provides exposure beyond today's largest companies while still delivering strong long-term returns. It also fits well for investors who are concerned about concentration risk. A large share of recent market returns has been driven by a very small group of mega-cap stocks. To put that concentration into context, the top 8 U.S. companies, Nvidia, Apple, Alphabet, Microsoft, Amazon, Meta Platforms, Broadcom, and Tesla, now have a combined market capitalization of roughly $23.5 trillion. That alone represents about 82% of total U.S. GDP, an extraordinary level of market value concentrated in just 8 companies. Globally, $23.5 trillion is larger than the combined GDP of China and Germany, which together are around $23.4 trillion. Put another way, the market value of these 8 companies is roughly equivalent to the combined economic output of 8 major countries from Japan through Russia, including Japan, India, the United Kingdom, France, Italy, Canada, Brazil, and Russia. At this scale, future returns become mathematically harder. Growth can continue, but it takes far more capital to generate the same percentage gains. This doesn't mean today's giants will stop growing. It means a larger share of future market returns is likely to come from new leaders, not from the current leaders simply getting even bigger. That's where ONEQ fits naturally. It spreads exposure across the full Nasdaq ecosystem, increasing the chance of capturing new leaders early while still keeping them as they grow. In practice, ONEQ works best as part of a broader portfolio. It can complement core holdings like SPY or QQQ by adding early-stage growth exposure without requiring investors to pick individual stocks. So what's the takeaway from all of this? ONEQ is not a replacement for SPY or QQQ. It plays a different role. While SPY captures the market after companies are established, and QQQ concentrates on today's largest technology leaders, ONEQ focuses on the full Nasdaq ecosystem. Structurally, ONEQ is designed to do 2 things very well. It can capture future market leaders early in their public life cycle, and unlike small cap indexes, it can keep those winners as they grow into larger companies. The performance data supports this structure. Over the long term, ONEQ only trailed QQQ, while outperforming every other major growth ETF and the S&P 500 without taking on meaningfully higher risk. In a market where returns are increasingly driven by a small number of mega-cap stocks and where those companies have already reached enormous scale, future gains are more likely to come from the next generation of leaders. That's where ONEQ fits best, not as a headline ETF, but as a strategic complement, adding diversification, reducing concentration risk, and increasing exposure to future growth. ONEQ doesn't try to predict the next Tesla or Broadcom. It simply ensures that when the next market leaders emerge, they're already part of your portfolio. That's the real value of ONEQ. If you found this analysis useful, feel free to like the video and subscribe to the channel. I publish research-driven content regularly, focused on long-term investing, ETFs, and how portfolio structure shapes returns over time. Thanks for your time today, and I'll see you in the next one.